Welcome back to the scaleUP podcast. Today I'm joined by Mitt and Daniel Welling from the MSP Finance Team. Today we're going to talk about M&A and is your business worth what you think it is?
Probably the most important sale you're going to make of your life. I think it comes down to the mystique surrounding it. It's almost a taboo topic. The reason for that is I've got a big pot of private equity money and yes, and I wish, and I think everyone should have a continual valuation of their business so that it's not, it's possible to almost have it on a dashboard, like using these metrics, this is what the business is worth today. I don't know if we're allowed to name names, but there are private equity.
You can name anything you want.
Okay, so
people even swear. I mean, we don't.
Okay, and that's something that will kill a deal even before you get to heads of terms and negotiations. To be honest.
scaleUP, the podcast for driving growth in your MSP, delivered by industry experts.
Welcome to the show, Daniel. For the audience, a little bit of background about you. How have you got to where you are today?
Well, there's a really good question. Not such an interesting answer though. I guess I've been in IT since the mid-90s. Salesperson by trade. Had what today we call an MSP, but at the time was an IT services business from early noughties through to 2014, and have enjoyed remaining part of the MSP community and marketplace ever since.
Great, and now you're more specialising in sort of finance and coaching?
Yes, and that really came about through discovering the MSP community post my first exit, and offering people advice and guidance, mostly unsolicited and mostly unwanted, until eventually someone said, you know what, I pay you for that, Daniel. And I thought, well, that sounds like a pretty good idea. And that led me into coaching, mentoring. And what I found doing that was, we were naturally focusing on numbers, and I was asking questions that perhaps my clients hadn't been asked before, hadn't paid attention to. And that led to coaching their accountants, bookkeepers, people in the business involved in finance, and that in turn led to, well, perhaps there's a service, a business here that we could offer and help MSPs with.
Great. And one of the topics today then we wanted to sort of dig into really and gain your advice and your experience on it is M&As. So, there's a lot of myths around M&As and buying or selling and what sort of structure you should go about. In your coaching and in the finance side, what's the biggest thing really around the M&A that you've seen?
Again, really good question. I think it comes down to the mystique surrounding it. It's almost a taboo topic. I recall back to my early years in IT services, MSP land. I was naturally interested in acquisitions at the time. I reached out and spoke to brokers at the time. We looked at some example businesses. I didn't have a clue, to be honest, though. I didn't have the money, didn't know what I didn't know, and I think there's a lot of entrepreneurial MSP owners that do aspire to M&A, and therefore want to go through that process. And equally, those at the end of their MSP journey, it's probably the most important sale you're going to make of your life, and therefore there's an awful lot of stigma around it in terms of, am I going to do the right thing by the customers, by my staff? Am I going to get the right outcome for me and my family? And because I'm maybe only going to do it once, it's a really difficult thing to prepare for.
Well, why do you think MSPs aspire to do some sort of M&A? I know you've got quite a few clients, so you probably have got some experience of speaking to a lot of business owners. What would you say? Like, why do they aspire to do M&A?
Certainly, my view on it at the time, again going back to my early days, was I saw it as a rite of passage. Like I'm a proper business person once I've gone through a transaction, and but equally, especially in the MSP marketplace. It's very rare to have an MSP business founded by a salesperson. And of course, you're a fellow salesperson by trade.
I was actually a techie first.
Oh, really? Oh, right. Okay. So just
I'm
a really
recovering techie.
Right. Okay.
Yeah.
A really salesy techie. So, and because most techies don't really take to sales culture, everything that being a salesperson can create tension. M&A is, as an alternative to selling, to organic growth, can be appealing. So I think it's probably for those two reasons that mostly MSPs resonate with the M&A.
So you think it's more, it sounds potentially sexy doing some sort of M&A,
Yeah.
and a lot of people see it as a way to grow, to do the M&A activity.
Exactly.
Okay. That's interesting. I mean, we had a comment the other day. Someone messaged me who basically said that they're looking to grow their business, but they're finding it very challenging to grow organically in their business. And he seemed to think that you're either a business that does M&A or a business that grows organically. What are your thoughts on that?
I agree partially with the sentiments. I think the challenge with doing both is probably one of resources and focus. If you're going to deliberately grow organically, you do need to build a sales organisation. It requires investment, and that investment, if you've only got a finite budget to also be looking at M&A, is probably the challenge, but not to say that you couldn't do one and then the other, and almost do in series rather than parallel.
And what would you say is more valuable? Let's take two sort of vanilla businesses. Let's say they're doing 3 million turnover each. They're both growing by 30% a year. One of them is growing by M&A and acquiring businesses, and the other one is growing organically by acquiring net new customers. From the outside, if someone was to look to buy those companies, what one would you think would get the most value, assuming they do the same amount of profit and the profile's similar?
If the only difference is the method of acquiring customers, and staff, by the way, with acquisition, that's the other key thing that you acquire. I would say probably the business that is growing organically rather than via acquisition. The reason I say that is whenever I've analysed the numbers, the cost of acquisition of a customer, of a user, when it's through M&A, is higher than when it's through a well-oiled, efficient organic acquisition process. So point one would be the economics of it, and secondly, you'll lose the momentum with the business that's grown through acquisition, unless they happen to bring a pipeline of deals. They're going to stop growing without further investment at that higher net cost of client acquisition. So yeah, I'd say the organic one would have the higher value.
Yeah, and I think that's a good point you've made there in terms of the actual cost of acquisition. If you broke it down like from a client by client basis and look at the difference in two, and you're saying that actually it's a lower cost to acquire a customer doing it organically, that's pretty important and powerful.
Yeah, I think you've also got the cost of integrations. So a cost of integrating lots of different vendors, different types of services, and different people and cultures. You know, often people want to see that integration's been 100% successful before they're going to purchase that, and often it's not 100% successful. Is that something you see, like the people and the structure of the business?
Very, very much so, and there's actually a couple of schools of thought and a couple of methods that I've seen adopted here. Some are absolutely that traditional integration method, and others are acquiring and effectively creating a group of individual businesses, perhaps with some element of shared service or leadership or almost like a mini community. And I don't know if we're allowed to name names, but there are private equity.
You can name anything you want.
Okay, so
people even swear. I mean, we don't. But.
Okay. Well, Evergreen as a point.
A good example of that community.
Example. Yeah, and actually the essence of what they are creating there is you've actually got an MSP that can that through its various brands and entities can actually approach a much wider marketplace than perhaps a fully integrated single brand, single entity MSP, because they could have an MSP in their estate that's absolutely focused on a particular size or geography or niche, and that's part of the problem I think you allude to with the integration.
Yeah, trying to bring them together.
Because actually the customers were buying at a different price point. They had a different service level expectation, different part of the world. Lots of things that you need to reconcile together, and that's probably going to end up cutting away some of the good.
Yeah, I mean, one of the things that jumps to my head there is my wife worked for banks, so people didn't realise that Halifax and TSB was the same entity, and so they would get people coming in saying, "We're leaving you, we're going to TSB," and they'd be like, "Okay, if you want to do that transaction, go ahead," but really it's the same place.
Yeah.
So talking about Evergreen's Valuation, as you've named that company, they do have a different business model, like you're saying, they leave brands intact, etc., where the more traditional private equity kind of play is that we combine them all into one super big MSP, and I suppose the idea is around trying to create some synergies of cost, trying to create sort of bigger processes that are more efficient. But it sounds like you're saying that really happens. Back to kind of like the value side of things, I probably still think that monster MSP will probably, if all things being equal, will probably somehow be worth more than the Evergreen approach of having all the smaller companies if they went to market.
And I think the final part of what you said there is the key element, because Evergreen, and not wanting to do an advert for Evergreen here,
sure,
but their business model is buy and hold, whereas the traditional private equity model is actually buy, combine, and then sell on. They're looking for an exit. So
probably going after different client bases as well, aren't they? Because the ones that tend to combine, they tend to then go after customers that need a UK outreach, multiple locations, for instance.
Yes, and also perhaps there's an entirely different structure in terms of the role that the owner has. So in the sort of traditional private equity model, the immediate benefit is, well, let's take out all of these duplicated people, and therefore straight away we're starting to realise some gains. But if the business is of a certain size and disposition, it will not suffer easily having that level of management cut away. And perhaps the buy and hold model is more aligned with keeping that business intact and that leadership intact. So, but now they're freed to develop in a different way.
I mean, one way to think of it actually is that if it's a company that Evergreen's bought, as they're leaving most of the leadership in place, most of the ways that company does things in place, they should probably have less churn of people, less churn of clients, and therefore their profitability should probably be higher than the traditional private equity company that comes along and tries to clump them all together. I mean, my personal belief is I think it's not an Evergreen advert, but if Craig Fulton wants to slip me £50, I'm more than happy to accept it. But I think their model makes sense. It really does for like the longevity of what they're doing.
Agreed.
So stay on that valuation front that we keep going back to. I think one of the problems with the buy and sell is the valuation and what's in people's head that the valuation should be. You must have seen that a lot, even with the purchases and sales that you did yourself. That valuation number can be wild apart.
Yeah, it can, and My personal belief here is that this is a topic that the market needs to educate itself on, and well, I'm very happy to share freely and openly in these sorts of forums, because the first misconception or mistake of an inexperienced seller is going to market with the number that they need in mind, rather than a professional assessment of what it's actually worth to someone. And one of the lines I particularly liked and have used on multiple occasions is, it's only worth what someone's prepared to pay for it. So what would you pay for it if you were buying it without your knowledge and intimacy with the business and acceptance of its perhaps limitations, and as well as being enthusiastic for its positive attributes, and that's perhaps the place that most sellers going to market should actually start with. Actually, what would I pay for it? How long would it take for me to get my money back if I were to pay someone else?
So I suppose your approach there is actually get a market value of what it's worth, and then work out what price you want for it. Whereas at the moment, how do people just make up a figure? How do they come up with the price at the moment that they want?
Yeah, as I mentioned earlier, there's a mystique, a taboo around this, and it's almost like going to the doctor. You don't really, so actually, I think a lot of people do exactly that, and when they look for a valuation, they perhaps look in the wrong place. So maybe they look at a business broker as a route for evaluation, which of course you have to bear in mind what someone's bias is towards providing that valuation. So yeah, I would always suggest someone find as independent a source as you can, and in the same time as when you're seeking a sale, to try and cultivate multiple buyers, and that way you'll be able to triangulate into what is actually the fair market value.
So you said a word there, biased, and it sounds like broker bias. Can you explain what you mean by that, and what sort of bias there normally is?
Yes. So, and this is my bias coming from about brokers, by the way.
Yeah.
But yeah, essentially we're saying, well, like if you're going to sell your house, you go and talk to 3 estate agents, and the estate agent gives you the highest valuation. You're probably going to go with them. Yeah, I like your answer much better than that one. And the same is true. So yes, the valuation may be less realistic. Not to say that it's impossible to get, but a certain number of elements have to fall into place for to achieve that, and that's not always possible or probable. So yeah, I think if you can seek multiple sources and also multiple methods for valuation, that would be the best.
So
advice.
I suppose in your kind of house analogy, it's like out of those 4 estate agents that have come around, let's say your house is $1 million. One said it's worth 1.2, one said it's worth 1, one said it's worth 900. But actually, you should probably be looking at how many of those estate agents have sold houses in the last 30 days, and are you going to end up with the highest one, and your property is going to sit on the market for 6 months?
Yes.
I suppose that's a bit of it.
Yeah, quite right. And so the first preparation takeaway, if someone is thinking about valuing their business, and I think everyone should have a continual valuation of their business, so that it's not. It's possible to almost have it on a dashboard, like using these metrics. This is what the business is worth today, and again next month, next year, and so on. But to basically equip yourself to be able to self value the business, and then you're not reliant on those third parties and any influence or market conditions or situations that may or may not come to play when you do sell.
So when you think about that dashboard, what would your advice be from what you see? What actual data points should be people looking at?
So the two best qualify best, perhaps separately. The two best methods I use is for an established MSP business. I'm looking at EBITDA, but I'm looking at EBITDA normalised. So not just adjusted. So the first EBITDA adjustment is we'll just take away all of the costs that relate to the shareholders of the business, regardless of what their role in the business or not is, and that's adjusted EBITDA. Okay, but a buyer's going to say, well, now we need to normalise that EBITDA for what the market competitive remuneration
For that role.
for that role for those owners that are active in the business, and there are probably a good number of MSPs out in the market trading where what they're currently taking by way of income from the business is actually below what they could earn if they had a job. And so therefore, if they only normalise for what their income is, they might be under, and therefore their EBITDA normalised is going to be less than what they think. And of course, whatever your starting number is, that's what a multiple is applied to. So before you even get into, is it 3 times, 5 times, 10 times, and guy at the pub said he got 20 times.
Well, they're going to want 20 then, aren't they?
Exactly.
If the guy in the pub got it.
Yeah. It's bound to happen, right? Bound to happen. So EBITDA normalised. We can talk a little bit more about that. And my other number for the businesses that are perhaps of a smaller scale, let's say below $1 million, I tend to take their core managed services income. So whatever they're charging per user, per device, per month, and it is 1 times the annual value. So a £1 million revenue business, for example, might have 400,000 of core service.
So is core service like any monthly recurring thing, and you're just annualising it?
Or is it just the IT?
Just the core service, yeah.
So just the IT support, maybe a bit of security.
Yeah. Again, there are grey areas here, but I would say anything that's a solid 50% plus
Margin.
Gross margin, correct? Yes, and that generally removes from the equation all of the Microsoft 365 licenses.
Yeah.
Perhaps it includes some managed backup, disaster recovery. Again, there's some debate and discussion around that. But and if you were to take that same £1 million business, and we've just valued it one way using the annual recurring times 1. If you were to calculate that they were making, let's say, a 10% normalised EBITDA, so they'd be making £100,000 after the owner's been paid what they could have earned elsewhere doing the same job, and then if you were to apply, let's say, just to make the numbers stack up in my example, let's say you applied a 4 times EBITDA, normalised EBITDA, that obviously gives you the same answer. So those two mechanisms triangulate the same number.
So 400,000, 100,000 times multiple of 4 gives
Correct.
you 400k,
Yeah.
and 400,000 for the annual recurring revenue that you're saying of the core services.
Correct. And then imagine a scenario where those numbers start to diverge. So let's say this £1 million business sells an awful lot of products, and actually their core MSP service is 200,000. Well, our first valuation method now puts their value lower, and if they're selling lots of products, they're probably not going to be making the same EBITDA, and therefore they're probably going to end up with a smaller EBITDA and a smaller and perhaps even a different multiple. And I could go on, lots of variations, but yeah, those are the two methods that I tend to use, and eventually you get to a point where the EBITDA multiple, normalised EBITDA multiple, is the safest mechanism, and then it's about, well, what is the multiple, and the multiple increases with scale, and so the reason for that is I've got a big pot of private equity money, and yes, and I wish, and I need to go out and do deals, because my target is to get to 2 million or 3 million in EBITDA. Ideally, I just want to buy £1 million business to get me that extra million. I don't want to buy 10 100,000 EBITDA businesses.
And I suppose it's down to deal cost, time of the private equity people, time of the business owners having to do so many deals, and that's generally why you see a higher multiple the more EBITDA a business has. And are there kind of brackets? Is there like 1 to 400,000, 500,000 to a million? Are there brackets that you think apply to multiples?
In some ways, yes. I mean, you could almost draw a line anywhere, and you probably wouldn't be far off. But yeah, sort of the mid market is like 5 times EBITDA. That's the sort of mid market. And if you if you had a true £500,000 EBITDA, and therefore 5 times gets you to 2.5 million. Well, I guarantee you'll get more than 5 times if all other parts of the business are accurate and in good order, because there's not that many £500,000 normalised EBITDA businesses out there for sale. So then you end up with the tension of multiple buyers, and if any of those buyers are towards the end of their private equity cycle, so they've got to do one more deal, they only need another 500 before they're now at their target to then sell themselves. Perhaps they'll pay way beyond 5 times.
Before, about some common pitfalls that you've seen. Maybe things have failed at the last hurdle. Talk a bit about that in your experience.
So reflecting on some of the deals that haven't happened, either they haven't got to heads of terms, or they've got to heads of terms and then they've not got to completion. A couple of examples. One would be quite a detailed point around the mechanism for payment, but it wasn't actually that issue. It was the fact that it surfaced an underlying trust issue that hadn't really been fully worked through in the heads of terms phase. And reflecting back, I'm not sure how you'd actually have corrected that proactively, but yeah, it is well documented that lawyers and accountants can derail a very well thought through and constructed transaction heads of terms agreed between the entrepreneurs in the room. So perhaps not a pitfall, but a good tip.
Yeah, can you tell us a bit about the trust issues? What do you mean by that?
So I mean, ultimately, you are establishing trust quite early on. Although there's a legal framework to protect against both parties falling foul of the transaction, ultimately it comes down to someone's got to pay some money and someone's got to receive something back for that. So will I get paid the money, and will the buyer get what they expect? And what is the recourse for either party if that doesn't happen? Very rarely will you have a transaction that is 100% on completion cash with no warranties and no, in fact, never almost. So So yeah, there is a level of trust that has to be established there. And it probably comes back to the sales adage that we were talking about earlier: know, like, and trust. If you can't build that level of rapport between buyer and seller during the negotiation heads of terms phase, then it will cause issues down the line.
So I suppose some of the things we're talking about here is legal paperwork, like a shareholders agreement and warranties and stuff like that. And you're basically saying that when you've got your own legal team looking at things, they may be advising you, hey, this means this and this means that. And because you've never been through a process before, you don't actually know, is that standard? Is it not standard? Are these guys doing it just for me, etc.? And that causes trust issues between both parties.
Yeah, I mean, don't get me wrong. Each party's advisors will be giving them good advice for good reason. But the buyer and the seller has to make their own judgment on what focus to put on that advice. And my tip is that buyer and seller should maintain regular open communication between each other rather than deferring to advisors talking to advisors, because you can end up losing the trust, and ultimately it's a continual negotiation all the way to completion and then beyond as well. It doesn't end at heads of terms.
Yeah, so I suppose you're basically saying keep on speaking to the buyer through the process. I mean, one of my friends sold his company to a private equity company, and there was a similar-ish problem, and the advice I gave him was like, get the private equity guy to come down to your offices, sit in a room together, and then instruct your solicitors collectively on what you want to do. Otherwise, you end up with one solicitor arguing with another one and two people who actually probably could be amicable and work through it pretty quickly. They can't because they've got these two other people they have to go through.
And the time involved of all of that back and forth
and the cost for both sides
and
of
the cost.
party.
You talked about another sort of word there of heads of terms. I don't think everyone would know what that sort of means.
Okay, so you have your negotiation discussions, and so we've now reached an agreement, and we're going to pay this on these terms, and these are the considerations. So it's a non-legally binding summary of all of the points that have been discussed, all the way through, and effectively serves as the starting point to instruct legals on both sides. So again, a top tip is not to rush that heads of terms. The more thorough and complete it is, the less chance you've got of something coming out later on. But equally, you are not trying to create a share purchase agreement or an asset purchase agreement in full. You're just putting in your own language what you want to happen, and then the legal teams can create the supporting documents.
Yeah, I mean, I was asked a question just recently actually about how much should you share at that process. So like I've seen people get points and money deducted from at the last resort because they didn't share that, let's say with this big customer was actually in distress and they were going to cancel the service quite soon. And before it's finished, that service is cancelled, and so they drop the money because of that. You know, sort of having some thoughts about how much should you share?
To be honest, as much as possible, because it's going to come out eventually, and the sooner it comes out, if that is a deal breaker, then you'd rather know about it now than
and not waste your time and money.
Yeah, exactly. And going back to that point of what would you pay for it? You could extend that to what would I want to see if I was paying for that? And a seller should be ready to engage in that process again on a continual basis. So you have what's called a data room once you get through the heads of terms, and then you start doing due diligence. So it's basically all of the stuff that you might need to share with a buyer. If you've got it all in one place and it's not neatly organised and indexed, yes, you want to see the shareholders agreement. Yes, here it is. You want to see this client contracts. There you go. And it's good practice financially to be monitoring the health of your clients and have some form of credit reporting going on, so that for running your business, if a client's in financial issues, and therefore it's a risk to your business, regardless of whether you're selling it or not. But yeah, as the buyer, you'd expect to not pay the same amount if the what you're buying has changed.
So I suppose one of the things you spoke about there is really getting your house in order, right? Having the right documents, the things in place, etc., etc. I suppose most businesses could probably take that as, whether you're selling or not, to go through the process and make sure that you have those right documents in place, whatever they may be. What are the sort of things that people typically get asked through due diligence? Like, what are the things that you should have readily available, and actually you should probably be storing yourself as a business owner for good practice?
Contracts for a start, both client and staff, supplier contracts as well, a summary of exactly the commercial relationship so that you can define it. That's probably more a report that you would be able to initiate at a point in time, because it will be in constant flux. But here's a list of all of our clients and the number of seats they have, and the areas that their geographic area, the business type that they are, and the fact that you sell them X, Y, and Z. It's that sort of information that you're likely to be asked for. You would of course provide it in an anonymised format until such time that you were sufficiently advanced in the transaction. So yes, having those sorts of documents are key.
And what about sort of like the financial information? I know a lot of businesses, even ones that are doing £2-3 million, that don't have a right set of management accounts that are done on a monthly or quarterly basis. What would that look like in terms of the stuff that you should really have when you're operating at that level?
Management accounts, one of my favourite topics.
So only a finance person would say that's a favourite topic.
Exactly, cue for people to go to sleep.
Well, he's actually a salesperson that's turned into a finance person, which is even
weirder.
You never normally hear that. Yeah.
No. So yeah, I mean, monthly management accounts, profit and loss on a balance sheet can include a lot more. But if you've got that as a record in time, going back as far as you might need to, at least 3 years, I would say, and as far back as you can, is key to instilling confidence in the buyer that you're a good seller. You're on top of and in good command of your business. If you can't provide that sort of information, then it's, well, what else don't they know about their business? So it's not that the seller is withholding something; they just don't know it, so they can't tell the buyer. So yeah, profit and loss on a balance sheet, point in time, and if you have perhaps a senior leadership or a board meeting every month, the minutes from that meeting, and that just goes into your data room each month, and then you've got it all there ready to share.
I suppose. There are the typical types of questions that people ask for your due diligence, and I imagine as time goes along, people may start asking more revealing questions, like you're saying, like the management reports, as well as the management reports, the board meeting notes. Pretty much, I imagine most people don't even have board meeting notes, and that's why they're in a situation. So that tells you a bit about a business anyway, in terms of how they're run. I mean, I've done some property transactions recently, and one of the things that I do, which I kind of learned from going through PE due diligence, is I did an NPS survey on the people that rent the flats.
Okay.
So I did an NPS survey with a score, and then I asked them 2 questions. What do you like about the place, and what do you dislike about the place? Very simple, but it gave me a whole host of information that I wouldn't have had from the buyer, from the seller, sorry, because the seller was just saying, yeah, everything's great, it's brilliant, but he told me about all sorts of stuff. So it is interesting. I think getting those documents in place, having the management accounts, getting things done in a right way will lead you to a much better outcome.
Absolutely, and customer and staff satisfaction surveys. If you have that information to reference as well, again, you should expect and be prepared for a buyer to take up client references as well, and of course, one of the key attributes we've not mentioned thus far about either valuation or discount, is the client concentration issue. So if you've a client that's even over 5%, to be honest, that's still quite a chunk, isn't it? If that client disappeared, so it's being particular about managing your client estate to not necessarily not winning a customer because that they become an outlier, but then you've got to go and win a lot more so that they're not an outlier.
Yeah. So I suppose the more risk a buyer has, the more likelihood that you're not going to get 100% of your money up front, right? So if you've got this situation with customer concentration, it may be that your payout period may be over a period of time to make sure that customer sticks around. Is that what you typically see?
Exactly right. Yeah. So the deferred consideration becomes performance-based rather than contracted, and if the client sticks around, great. And by the way, though, that can work in the seller's benefit as well, because if the buyer is able to generate more and grow the business, then the seller can share in that reward as well, having a performance mechanism. So
I think that's also one of the things that some people don't think about is how long they're going to need to stay around after the sale. Is that changing?
Well, as we described earlier, it depends on the buyer and the seller. To be honest, at minimum, you'd expect to provide a handover. I think in my case, it was effectively 3 months, but it was a number of days that would be delivered within a set period, and equally, some shareholders are retained in the business thereafter. They either become shareholders in the acquirer, or have an opportunity to pick up a role and stay. So, and again, that's all part of the negotiation phase. What is it that you're looking for as the seller, and what does the buyer want? But yeah, generally, if you're staying around, that immediately de-risks it for the buyer. Anyone that's wanting to go quickly, that's a risk.
I think it's a difficult one, isn't it? I think I've heard deals happen where they only want 3 months, and I've heard deals happen where they want someone to stay for 24 months. It is a tricky subject, but I imagine it's all about risk, right?
Yes, exactly. Yeah. And ultimately, the risk and the value are interlinked. I recall a conversation with my solicitor, and that was the first time I'd been through the process, and we're looking at warranties, and I'm like, do I really want to be on the hook for this period of time? And I think her words were something like, well, you could probably get that removed if you reduce the price. Okay, well, perhaps I'm quite happy to take that clause now because I'm getting paid for it.
Yeah, and I think sometimes people just need to think about like what's the normal thing that happens, right? I had a conversation with someone the other day where they were like, they're making me sign a warranty that if anything's wrong with the tax for 7 years, and I was like, is anything wrong with the tax? They're like, no, I don't think so. I was like, so why don't you mind signing it? It's not a big deal then, right?
Exactly.
Why make it into a bigger thing than it is?
Yeah, I mean, you touched a little bit about having that quarterly pack, etc. Do you think there's anything around, are you actually reporting your finances? So we do a lot on what does the GL code in the chart of accounts look like. Do you think that does anything on the sales side?
Absolutely, because if you are managing your business with a level of maturity that would come from having a well structured chart of accounts, it's giving you management information that you can make decisions on to improve the business there and then. So naturally, the business will be generating a higher gross margin and have a higher normalised EBITDA as a result. But it will also make the buyer's assessment of the business far easier. And again, if there's a business that is only able to provide statutory accounts with one line that says sales, and there's another company over here that has an SLI or equivalent inspired chart of accounts, sufficient granularity, brilliant. I'm just going to forget this one and focus on this one for now.
Yeah, and I suppose what the detail in the accounting process, back to your point of when you were talking about valuations and whether Office 365 has a slightly lower value or a higher value, is that if you've got that detail and you actually know what you're billing for Office 365, it makes it very easier for the buyer to go, okay, they're doing this amount, I know that the company's worth X or Y, rather than having to go through a huge amount of anonymized data that they can't understand.
Yeah, and that's something that will kill a deal even before you get to heads of terms and negotiations, to be honest.
Great. So we've had a great conversation today. Just to sort of summarise this for our audience, what's our key takeaways from this conversation?
I think for me it's education and becoming familiar with the topic, consuming content, and listening to people that have been through the process, and if you can, make sure you've got some advisory to help you along the way.
I think for me, really, we touched a bit on the legal side of stuff and really understanding what normal looks like in the legal world for some key documents like shareholder agreements prior to even going into a sale process. Maybe just educating yourself now about what those sort of documents look like and what to expect.
Great. I think mine is almost linked to that education bit, but running your business with that data room in mind. So if you're not there yet, understand what needs to be in that and constantly be at that point where you've got that data all the time. I hear so much about how much time someone's had to put into something when they're ready to sell because they didn't have it in the first place. So sort of understanding that and getting it ready.
Thanks for joining us today for this episode. Daniel, thank you very much for being part of what we've gone through today. Please like and subscribe. And if you guys do have any questions to ask us, either reach out to us or leave them in the comments. Thank you very much.
Thanks for tuning in. If you enjoyed this episode of scaleUP, don't forget to like and subscribe. If there are any topics that you would like to see on a future episode of scaleUP, please leave a comment below.